Alright, folks. Before I start with the weekly, I'm going to reveal something, which is candles are ranges. That's it. Candles are ranges. Ranges are either turtle souped or they are truly broken. Now, what does that mean? That means as follows. This candle was a range. All right, let's choose a simple one to begin with, because when you're learning something, then the simple version is what you should be learning first, and then moving on to the more advanced version. All right? This candle, this specific order block, for example, was a range, is a range. This whole thing. As soon as we close above or close below the order block, or below the order block, when we close above or below a candle, it indicates continuation. When we wick, but we don't close, it indicates a reaction either for a reversal or a retracement. All right? We close below the low or above the high. So over here, we close below the low of the candle. It leads to a dig back into the candle and continuation. All right? So candles are ranges. And I hope you're taking notes, by the way, because I talk a lot, right? Because there's different styles of teaching. I talk a lot, and I'm expecting you, the listener, to take notes. Otherwise, you're fucked, right? Because I will point out the important stuff, but if you don't take notes the first time, you're probably going to end up taking notes the second or third time, or you're going to be forced to listen again to understand. So take notes and listen properly the first time, and you will be good. So candles are ranges, right? A range is either broken truly or broken falsely. When we close above or below a high, close above a high or below a low, equals continuation. All right? When we wick, but we don't close, equals reversal or retracement. Continuation of the close, right? Don't mistake it for continuation of the trend, because that depends on the higher time frame order flow. Wick, but no close, equals retracement / reversal. This especially applies to my 3-candle model, the 3-candle pattern model, which you'll be seeing more examples of right now in the weekly range, right? Let's see. Right here, we had a higher time frame range. We dig into an extremely old liquidity pool. 3 months low, previous 6 months low, previous 12-month low. These are important landmarks. We dug into the previous think it was like a 9 month low. One of the highest probability models you'll ever find is taking all liquidity, right? Taking all liquidity and transferring it to a recent liquidity pool, right? What does that mean? Old liquidity pool to a recent old liquidity pool to a recent liquidity pool. All right. We're digging into this low. So the highest chances, the high that led us to that low is probably going to be taken out right here. All right. But how do you enter that? You enter that one of the ways, either a blind entry or a higher time frame entry, or you can wait for the model to form. I'm waiting for a candle. I'm waiting for my good old 3 candle pattern, right? Let's wait for this thick, high volume candle to form into the liquidity pool, preferably, right? Right here, you see this? Below this candle is a key level, the opening price of the order block, right? So keeping in mind this weekly candle, we're trying to take, assuming we don't close below this week's candle, we're going to be looking for buys these 2 weeks until we take out this candle's high. If you go back a few episodes, then you'll notice this is exactly the pattern I spoke about. Pattern with a logic. Weekly candle, 2-hour time frame. Check this out. So we're below the range on the higher time frame, right? We're looking for a range below the range. And a range will show itself to you. You will never, if you force a range, you're going to fuck it up. A true range will show itself to you. You will never need to second guess, is it a range, is it not? Nope, it's going to be right there. So this, where's the week? Weekly candle up until here. Accumulation, right? Chopping around, up and down. Let's draw this one too. So over here, this would be week 1, accumulation, manipulation, and distribution. This is all working inside of one candle. Week 1, week 2, week 3. This is all happening within the same candle, right? And things are getting super fun as we delve deeper into the lower time frames. Looking for buys. Blend this with order flow, with the market profile, breaking highs, dumping below lows, rallying. But forget that for a second. Even below this low, right? So we have this range here. Below this range, into the key level, there is a smaller range. This was my entry, right? This is one shot, one kill. You really pick your shot. There you go. Beautiful. So below this range, and not blindly below the range, there's a time and place. So we had, this brings us, of course, to the classic Monday range trade. What is a Monday high to low trade? Right? There's two very famous models, which everyone talks about, and nobody knows how to trade, which is the Monday range and the Asian range, the Asian range high to low. Right? This is the previous week's candle. We are below an liquidity pool. We're expecting a bottom to form, right? Week opens. Normally we expect Monday's range to play out. We don't play on Monday. Monday range plays out. Below the weekly open, we're expecting a range to form and a change in the state of delivery through an order block or a breaker. Right? Below the opening price. Opening price, decline. This is a clear, defined range occurring when, by the way? Let's see. First of all, this is the Monday range, right? Just to visualize what it looks like. This is a Monday range play, what it looks like. Right, this is the range of Monday. On Tuesday, right, you can skip all this chop fest and start hunting at 3, which is what I do, which is the exact time a swing point is expected to form during London, right? Because you got accumulation. What's the time per manipulation in a daily candle? And I'm hitting 2 birds with one stone in this one. The time per manipulation is 2 a.m., right? Which means the time the swing high will form is 3. Well, 2:50 to 3:10, right? But 3 a.m. is the swing point formation time during that candle. 3 to 5 is a good range of time to place your bets during. But I digress. You look for manipulation to form. Let's stick to the rules of the book. Let's not be rebels. The time itself of the candle is 0, right? However, what usually happens is a bunch of chop, and you can start looking for a manipulation starting from 2, which is the classic, the by the book way, right? After 2, we decline into the previous day's low, Monday's range played out, remember? And we ride it, as I mentioned before, to the 50% and a violent retracement at 50% and to the high. That is also a model by itself. Monday low to high, Monday high to low. Backtest that one with this visual form. Below the weekly low. Right, so that is an example of a timed range model. The range is Monday. You're timing the Monday range. You're going to soup the Monday range by Judas, watching for it after 1 a.m. or 2 a.m. or you can do what I did. Right? During that time, during the London kill zone, quote unquote, and you ride it to the 50% and the opposing end of the range, right? That is a model by itself. But anyway, we're focusing on another one, which is the range opening price of the week, decline opening price of the day as well. So we're double discount. We're under the opening price of the week and the day. This is where the range is forming over here. Range, turtle soup of the range. Classic, you've seen me do this a million times, and you will see me do it 10 million times more. Turtle soup. As soon as you break that high, the low is in. The time and the price are both blending in together to form an excellent opportunity for low. Right? No high was ever broken, by the way. Up until this point. Rejected. Not even traded to. FVG. Rejected. Broken. During the time, which is Monday, we've taken the Monday low. We're below an old liquidity pool. We're below the previous week's low. 3-candle formation, remember? Accumulation, manipulation, distribution. Week 1, week 2, week 3. Right? All of this blended together gives us a chance to either hold till here, or you can also keep holding from that small range down there. You're using the 4-hour candle and the 1-day power of 3 with a higher time frame target at a higher time frame key level. This is all happening at the weekly order block, right? It's incredible when you realize what you can do with this if you're focused enough to do it. You got this over here. All right. Check this out. At the key level, the timed range model, this is for the notes, and this is 1 down. Apart from the week 1, of course, that's another timed range model, which is week 1, week 2, week 3, right? So you're taking week 1, week 2, week 3, right? Up until we completely harmonize, is that a word? Harmony is delivered to this candle. You see that beauty? From this candle, turtle soup, this weekly candle, Monday range, Monday low to high, over here, and bingo. This is all happening within this one candle, you notice? Do you see how clean it looks now? You've probably never seen this before because nobody has ever spoken about this model ever before. And I predict that many people are going to start talking about this model after this recording, which is using the candles themselves as targets, right? Looking for buys until we hit this. All of this is happening within this one candle, right? The higher time frame, we're looking for a lower time frame range during this specific time, Tuesday, after Monday's range is choppy, to fulfill this candle's destiny, which is taking it from the low to the 50% to the high. And that is two extremely important concepts, which, there you go. You have it. If I stop right now, then I have done the job with what you've learned, which is incredible. But I'm going to keep going. By the way, same thing here, right? Monday plays out. Where's Monday? I haven't even seen this, and I know how it's going to play out. Monday range, right? Yeah, Monday range right there. Monday range. Important liquidity pool. Market profile breaking highs. Dump below the low, rejection. Monday low, accumulation. Manipulation. Wednesday looking for buys. 3 candle formation. Remember? And bingo. Using timed ranges. Blending those with the 3 candle formation. Some people say 4. I prefer 3. And blending this, if you've noticed, I've never mentioned a single PD array. I've mentioned maybe a higher time frame key level, only monthly, weekly. But on lower time frame, it's mainly lows. I'm mentioning ranges, breaking of highs, rejecting of lows. That's how pro order flow, right? And of course, a classic intermediate term higher low flip. Just a beautiful classic sight, right? That's the weekly range. Again, weekly open, declining below the weekly open. Every single buy when you're bullish is below the weekly opening price. Every single sell is above the weekly opening price, right? Weekly open, smacking back into the weekly open, timed range, soup, 50%, opposing end, bingo. Flipping the range, breaking out of the range. Ranges are either turtle souped or truly broken. And if some of this is flying over your head, by the way, and you haven't taken the first one, then I would really recommend taking the first one. And going through my material as well. That will be helpful. So yeah, that's the weekly range. That's the weekly range defined into a 3 candle formation: Monday, Tuesday, Wednesday. What if Monday expands? You do nothing. What if it closes below the low? Then it's a real breakout. You follow the trend, right, through a deep retracement, or you simply wait for your model, right? Next up is the the daily candle.